Yeah, hello, Winfried Müller. I'm member of the advisory board of Aalborg University Business School. Very happy to be here again. 2 times a year we meet for the advisory board, and it's always a great pleasure. So being here, I linked it together with this wonderful task to talk some words about the world we are currently in. Within international business, I'd like to talk today a little bit on 2 monetary phenomena, inflation and interest rate. For many years, they have not been big topics, even though central banks, namely the European Central Bank, has blown up the monetary base at a very big extent. But now suddenly, also by the supply leakage due to Corona, inflation has passed its way through, and we are currently facing double-digit inflation in most countries of the Eurozone and Europe. And we need to look from a business point of view. What does it mean? What could be next steps? Where is that leading to? And what are practical recommendations and also for businesses, how to protect and how to steer forward? Inflation is pretty much a psychological phenomena as well. Why is it the case? Because if we look at today's inflation rate, we can predict 2 directions. One direction is people afraid of the future are reducing their expenditures, which is, of course, on the other side, stupid because the money they save is losing value. On the other side, if they would start spending money, inflation would even increase because the velocity of the monetary flow in the circulation of money would increase, and that would further on drive as a second round effect inflation. We are seeing the first stages of a credit crunch, which means a limitation of credit supply to the economy due to the fact that, of course, interest rates are rising, so the cost for the company are rising, and banks are more prudent in the expectation how critical the upcoming recession might come. And that can bring companies into difficult situations, households as well. So the available household income, that was pretty much a stable factor for many years, is going to change and is going to put additional pressure on all economic elements. Inflation itself is a quite unjust taxation. It is a kind of taxation that comes on top, and it's unjust. Why? Because it is socially unjust. It hits those people most who need to spend big parts of their income on household goods, on food, on energy prices, and it does not hit those people at the other end of the income and wealth chain, which are much better off. So what are governments doing in order to keep the social adequacy and the social stability intact? They react with support packages. So with those support packages, partially, they are not very market conform. They are going against the market, and they are creating the next round effect on inflation as well. So here, spending on deficit is, if we talk about sustainability into the future, also not the most sustainable things to be done. It might be unavoidable in certain areas in a very short time, but it makes causes problems for the future. If we take the interest rate development a little bit bigger and we look within the whole Eurozone, then we see those fragmentation topics of how to keep interest rate in the southern parts of Europe and the Eurozone somehow under control. And this is not the basic interest, it is the risk add-on. So it is the credit spread what countries like Italy, Spain, Greece have to pay on top of the risk-free interest. And here as well, it's a two-sided sword. On the one side, nobody wants a Euro crisis 2.0. On the other side, calling it transmission protection mechanism, the European Central Bank has still kept the box of the Pandora open in terms of extending the monetary base and therefore also setting the base for next potential round of inflation. Looking from inflation towards interest rate and US dollar. As you know, US dollar has upvalued, has increased in value during the last month. That was mainly because of the very favorable interest rate development. So interest rates have risen in US much stronger than in the Eurozone. And here we should not forget the rest of the world, mainly the emerging markets, the frontier markets, who are highly indebted in US dollar. So for them, it gets more expensive to repay their debt, first of all. And secondly, it gets more expensive for them to get new debts because they are with a high interest rate tag. We have seen the first country, Sri Lanka, stumbling a couple of weeks ago. Let's see how the next one is. But in all the discussion on China, Russia, Europe and US, it seems sometimes that we have forgotten the rest of the world, especially those African and Asian countries, which could be seriously negatively affected by that. And given the interest rate environment of the last years, they indebted, especially in the corporate and in the individual side during the last years, quite a lot. So all of that mixed together, what I've mentioned, that set of facts, call for the question, are we facing a normal recession? Honestly, I would be very happy to have so, because a normal recession lasts a year, lasts 1.5 years, and resulted then in a kind of new, fresh dynamic where we can stand up and continue? Or is that a complete different kind of animal when we talk about all the discussion on deglobalization, on friend shoring, means you only make business with your friends. You, so to say, build blocks in the world with whom you do business, with others not. And that sounds pretty much like taking the last 30 years of globalization back. And globalization has had some negative effects, but on the other side, it also created value and additional income for hundreds of millions of people. And turning that back will also, in our markets, in our countries, absolutely reduce the level of wealth, the level of prospect for people to work, for people to live. So that big question will be decided, I would say, in the next year to come. Normal recession versus something bigger out there, taking globalization back. But what does it mean for companies? What should the organization do? And what are kind of changes towards the last years where we were not facing with inflation, with interest rates? First of all, get your internal corporate foresight and corporate risk management up to speed. Get it resilient, and resilient is one of the buzzwords I do not like too much, but what I want to say is get your view on the outside world and also those less likely but high impact for your company in order. What does it mean? Check your supplier, check your customer, check the way you produce. Are you having bulk risks? Are you having big risk elements which could, if they realize, kill you, even though the likelihood might seem to be small? I think we have experienced it the last time that small likelihood can get a big impact at the end of the day. Monetary-wise, treasury-wise, money comes again with a price. The time of interest risk-free or interest rate-free environments are gone. Look that you can save cash in your trunk as a company. Cash is king. That has been always the case. Now it's again, which does not mean put everything on cash, but you can only die once by not being liquid, not having liquidity on your company. Cash is king means cash management, optimize your cash streams, and we have to again learn and handle those things which 20, 30 years ago, every treasurer, every CFO, every C-level manager always knew: the cost of money, the risk management basics, and we have to learn it again because for a long time that has not been in focus, or not enough been in focus. So with these things together, early warning, cash management, treasury activities, and being open for this silent little messages we get how the world around is changing, and it is continuing to change. It is not that this is a clear line into the future. I think we have a chance to set up each and every business, each and every legal entity in a very proper and good way. And I'm very happy to, of course, go into the discussion and ride the interesting ride into the future with you. Thank you very much.